Welcome to the weekly Macro Roundup, where we highlight the leading macroeconomic and financial market events for the week. Let's get started. The U.S. government officially declined to extend the CUSMA trade pact, choosing instead to trigger an intense renegotiation period rather than locking in a fresh 16-year term. While the current agreement legally remains in force until 2036 and existing tariff exemptions stay intact, the decision introduces significant, prolonged trade uncertainty across North America. The yen experienced severe volatility this week, plunging to a fresh 40-year low near $162.66 per dollar before staging a sharp 1% rebound past 161 amid intense currency intervention fears. The initial collapse was driven by the persistent wide interest rate differential between the Federal Reserve and the Bank of Japan, while the late-week recovery was triggered by softer U.S. jobs data and warnings from Japan Finance Minister that authorities may stop telegraphing their intervention tactics to catch short sellers off guard. Further volatility is expected without more aggressive monetary tightening from the Bank of Japan. Saudi Arabia's crude oil exports have surged back to 90% of pre-war levels, hitting 6.3 million barrels per day, as supertankers rapidly clear out of Persian Gulf ports following the recent U.S.-Iran interim peace deal. This aggressive ramping of shipments through the reopened Strait of Hormuz has triggered a steep sell-off in energy markets, dragging Brent futures down to near $72 a barrel and WTI below $69. The U.S. labor market slowed sharply as non-farm payrolls grew by a measly 57,000 in June, missing economists' expectations of 113,000. The Bureau of Labor Statistics also applied an aggregate downward revision of 74,000 to the previous 2 months, compounding signs of a cooling economy. While the official unemployment rate unexpectedly ticked down to 4.2%, macroeconomists note this decline occurred for negative structural reasons. The labor force contracted by a massive 720,000 individuals, driving the labor force participation rate down to a multi-year low of 61.5% due to worker disengagement. Wage growth remained steady at 0.3% month over month, translating to a 3.5% annualized clip. Russia's war economy has reached a tipping point of structural exhaustion, marked by depleted fiscal buffers and stalled growth, according to a landmark Kiel Institute for the World Economy joint report titled Endgame: The State of the Russian Economy. The research reveals that Russia's liquid sovereign wealth fund assets have plummeted from 6.5% of GDP at the war's onset to a fragile 1.8%. While its federal budget deficit shattered its full-year target within just the first few months of 2026, alongside a 45% collapse in Q1 oil and gas revenues. China's industrial profits expanded by a robust 18.8% year-on-year during the January to May 2026 period, accelerating from an 18.2% gain recorded in the first 4 months. However, the headline resilience masks a stark structural divide. The global AI infrastructure wave drove a staggering 103.9% profit explosion, whereas consumer-facing sectors like automotive manufacturing dropped 19.8%, and furniture makers plunged 58.4% due to sluggish domestic demand. The U.S. manufacturing sector experienced a noticeable cooling trend this week as the headline ISM manufacturing PMI fell to 53.3 in June, dropping from 54.0 in May and missing Wall Street expectations of 53.8. Mirroring this moderation, the S&P Global U.S. Manufacturing PMI was sharply revised down to 53.9 from its preliminary estimate of 55.7, signaling that while factory activity notched its 11th consecutive month of expansion, growth has slowed to a 3-month low. The U.S. Supreme Court handed a major constitutional victory to central bank independence by blocking the Trump administration's attempt to fire Federal Reserve Governor Lisa Cook. In a 5-4 decision in Trump versus Cook, Chief Justice Roberts carved out a distinct exemption for the central bank, ruling that the president cannot dismiss members of the Fed's Board of Governors without clear for-cause justification. U.S. consumer confidence showed highly fractured resilience this week as the Conference Board's Consumer Confidence Index inched up just zero point 0.6 points to 91.2, missing Wall Street forecasts of 94.4, but showing stabilization alongside the University of Michigan Consumer Sentiment Index, which rebounded to 49.5 from its recent all-time low. This marginal relief was heavily driven by a 3.0-point spike in the forward-looking expectations index, 74.4, as a U.S.-Iran ceasefire deal pushed national gasoline prices back down to $3.85 a gallon, visibly easing long-term inflation anxieties. Citigroup significantly lowered its oil price forecasts this week, warning that Brent crude could plunge to between $60 and $65 per barrel by the turn of the year. The investment bank's latest research note underscores a swift erasure of the market's war premium, cutting its average third quarter and fourth quarter 2026 targets to $75 and $70 respectively, while slashing its 2027 outlook to $65. This bearish shift is heavily driven by the U.S.-Iran Memorandum of Understanding, which has triggered a rapid normalization of maritime shipping flows through the critical Strait of Hormuz. Thanks for watching. Remember to like, share, and subscribe to this channel. And see you next week.